Hello, everybody, and welcome to the Crypto Hipsters Curtain Calls. This is your host, Jamil Hassan, the Crypto Hipster, where I bring you compilations of seasons 6, 7, and 8 of the Crypto Hipster podcast. And this episode is episode 50 of the Crypto Hipsters Curtain Calls, entitled Boogie Nights, Learning Life Lessons and Web3 Trading Strategies from crypto's role in liquor, laundering, lust, and luxury. This podcast draws upon 4 Crypto Hipster podcast interviews, clips from these 4 interviews, 1 from season 6, 1 from season 7, and 2 from season 8. The first conversation I had was from season 6, and it was with Justin Banon, my first of 2 conversations with Justin Banon. In November 4, 2023, I later spoke to him in season 8. And we talked about this first discussion was talking about the challenges with solving inauthentic Web3 washing. And Justin Banon is the co-founder of the Boson protocol. The second conversation I had was with Marc Walton during season 8 in end of February 2025. Marc is the founder of Forex Mentor Pro. We talked about lessons and insights from helping private clients invest in crypto successfully. A lot of people don't invest in crypto successfully. He helps his clients invest successfully. Third is an amazing conversation I had in May of 2025 during season 8 with Sam Mudie. Sam is the co-founder and CEO of Savea. We talked about whiskey, wine, and watches, where passion and crypto meet to create new investment opportunities. And last but not least, my conversation was with Jack McInerney from season 7 in April 2024. Jack is the founder of Renewal Coin. And this was part of my Crypto Hipster Presents episodes and Shooting from the Hip, episode 8 from that series. We talked about safeguarding investors against pump and dump schemes by building a best-in-breed, multiple asset-backed cryptocurrency. All these conversations can be found this episode, and each individual episode can be listened to anywhere you listen to your favorite podcasts, whether it be Spotify or YouTube or anywhere you listen to your favorite podcasts. Again, this is episode 50. We're going all the way to 67, but this is 50, entitled again, Boogie Nights, Learning Life Lessons and Web3 Trading Strategies from crypto's role in liquor, laundering, lust, and luxury. Thank you for tuning in. I hope you enjoy this compilation, and I'll see you at the next episode. Thank you and enjoy.
Oh, awesome. I was going to ask you about NFTs, but I will probably later on. The first thing I want to get into, though, is because I found this interesting, was Web3, this concept of Web3 washing, right? Yeah. What's that all about, and why and how does it continue to proliferate in the market?
Yeah. So, I mean, we talked about, that these Web3 technologies are kind of secure and verifiable. They're like hardened technologies that can be put together in a way that prevents fraud and gives both parties these strong and verifiable guarantees without the need for a middleman that transactions will execute as agreed, right? So it's a kind of like almost a military grade technology. It's a secure technology that you're using. And so if you're going to use secure technologies, then there's only a point to you. The only reason you would use those if there are going to be these secure outcomes for buyers and sellers, right? So, for example, if we want to do an NFT exchange, it's very easy for us to do an atomic exchange, or an NFT goes one way and the money goes the other, right? And you can do that purchase. But for the reasons I described of like these, these kind of different challenges with off-chain assets, what happens with a lot of these early implementations of Web3 commerce, whether it's people like Nike or, is they just say, okay, here's a pair of sneakers. I'm going to create an NFT. The sneakers are here. Buy this NFT from me. It's exactly the example I used with the car. Please buy this NFT from me. Okay, now you've bought the NFT. It's entirely based on trust that you're then going to get that pair of sneakers. There is no strong and verifiable guarantee. I mean, and the question is, why even bother using a hardened military-grade technology to offer someone a trusted promise? I mean, I could make a trusted promise to you now that I'm going to give you a pair of sneakers I've got in the next room, right? And that's just as enforceable if I wrote that promise on an NFT or an email or a WhatsApp. There is no hard claim. It's just using an NFT as an IOU. And, that is largely pointless. I mean, the reason we kind of call it Web3 washing is, what's the point of using a blockchain or Web3 for a use case that offers no more security or verification than a Web2 business model like e-commerce does? I mean, and so it's a pointlessness claim. And I mean, obviously, I mentioned this first master's I did, which was all about digital innovation, the history of technology. This happens all the time, right? So the first cars didn't have a steering wheel. They had like a boat tiller, right? Because they'd sort of inherited it from the previous paradigm. The early web, if you'd have like, e-commerce in the early web. So a travel agent, for example, wasn't sort of Expedia or, it was a little picture of a beach with a phone number. Call this number and come into the high street, and we'll book you some travel. And so likewise, it's completely normal for when technology first gets adopted, for it to retain the characteristics of the previous paradigm, right? So people are using Web3 technologies, hardened, secure technologies, to deliver completely trusted and kind of rug pull prone mechanisms. And so kind of in a not too much of a trolley way, but we are sort of calling out some of these use cases and encouraging brands to come and work with protocols like Boson, to where they can easily do real Web3, but in a super easy way for them and their customers.
You mentioned rules.
Yeah,
I'll talk about them. In the stock market, the rules are easy. You have to look at operating margins. You have to look at working capital. You have to look at debt capitalization and ROI. And there's rules in the balance sheet and income statement and ways that financial analysts do that. There are no rules in crypto, are there? What rules do you have to create to be an effective trader and investor because those particular things don't exist?
Well, even with stocks, I'm slightly different. I don't bother with the FANG stocks and things. The days of just put money into dividend paying stocks and it'll pay you 5-6% a year. Well, I mean, 5-6% a year, and you don't even get that with most of them now, is terrible, because the true rate of inflation is still over 10%. And I think the years of the dividend stocks even paying 5% have long gone now. Some of the FANGs don't pay any, and some are only paying 1 or 2%. So why would I want to buy something that's so expensive? And so the way that I deal with things is to look at things in a cyclical way. I made a lot of money after the financial crash getting involved in gold, because gold, surprisingly, as with COVID, dropped significantly when the crash came, but it only went down half as much as the S&P in 2008. And gold recovered within a year and then tripled, because, hey, common sense says when everybody's scared, if you had your pension and you were retiring in 2008 and you have $1 million in there, and suddenly you're woken up this morning and you've got half a million, A, you're not retiring tomorrow, and B, you're very wary about getting involved again. You know, the marketers and the hedge funds say, hey, and if you always have to notice, when do these funds produce graphs from? And a lot of them produce graphs from 2010. If you just put your money, yeah, but what happens if you put it in 2007 or so gold logically is the ultimate safe haven, and it's still the same this time. And I got into gold in 2022 this time when it was at $1,800 an ounce, because with all the money printing that had gone on with the COVID crisis, it was obviously inflationary. The Fed was saying, oh, we think we've got it under control and it might go up to 2%. And it's like, you're talking nuts. So if you can catch the right cycle at the right time. So I don't bother with the FANG stocks. I don't go too far into balance sheets. I look at the sector and the health of the sector. I look at remember, I only buy a stock if I think it can make at least 25%. The best stocks last year, apart from MicroStrategy for me, were gold mining stocks. And at the moment, I see gold mining stocks as being a good opportunity because the price of gold and silver in the ground at the moment, in effect, is at a discount. You have gold at all-time highs today at 2,900. You've got silver, I think, at $31 at the moment. But some of the mining stocks last year, my best mining stock made 260%. But the balance sheet and the formal way of looking at it, you wouldn't necessarily have bought it. And it's called EXK in Endeavour Silver. And it came down a year ago to the COVID low, and gold and silver were going up, and yet this was dropping. And I kind of looked at this and thought, well, hang on a minute. If this was how bad it got in COVID, this is a market where this product valuation is going up for reasons I believe in. This is cheap. And so silver last year was a really good year for silver. You made 35%. EXK made 250%. So for me, I am not looking just at conventional. I have zero interest in sitting holding Amazon, but I have levels set now. If it crashes, then I'll buy, because I want to buy it when it's cheap and at the right price. And if you look at what Buffett's doing at the moment with Berkshire Hathaway, he's sat on $350 billion in cash. And there was one of the headlines in the other day in one of the financial press. He said, you know, basically, we wonder why. Well, it's blooming obvious why, because he's expecting it to come down and then he's going to wade in and buy when everybody else panics. And so that's my kind of way of looking at things, trying to catch the right thing. So then in February 23, I started to see Bitcoin starting to pick up a little bit. I started actively buying again in the July when it was at 45, 50 grand. And I said last year, in the February last year, I said, I think that Bitcoin will hit 100K this year. And I got people saying, you blokes nuts, and why? But you could see a buildup of energy and interest. And now we've got the ETFs. Now the big boys, it's not a Ponzi anymore. It's not rat poison. Oh, it's actually really good if you come to us. And I have a client who's runs a family office in America. And he actually came to me 4 or 5 years ago when crypto started. And he was at the time he was working for a hedge fund. And he said, I understand from one of my clients, you're not trading Forex for clients anymore. Would you send them to me? And I said, well, how much did you make last year? In 2019, many of the hedge funds didn't make anything. Oh, 4 or 5%. Yeah, and what did the client get? Well, 3. Okay. And I showed him my crypto portfolio at the time, which was up almost 1,000%. And the guy's eyes went, what the hell are you doing? So anyway, he hired me, long story short, to teach him privately, which I did. Anyway, he's now for the last 3 years been working for a family office. And he was telling me for the last 2 years, it's been so frustrating prior to the ETFs because he could not recommend to the client to get involved into crypto. He had private meetings with some of the sons who were heavily into it, but the general concept, you had to go through compliance. Then even when the ETFs came in, it wasn't for some of them instantly they could get involved. It's been a slow build-up. Now, crypto per se itself, I think anybody with a decent amount of money ought to own at least one Bitcoin.
Yeah. Yeah. So I want to get into what you said you want to talk about now, the legal part. You know, you are actually taking this unstructured, not illegal, it's not an illegal market. It's one without legal, frameworks. you are taking a legal framework through the NFT and through other measures, and you're implementing that legal framework into this wild west of, I call it wild west, wild west of wine. So how are you going to be able to accomplish that, or how are you accomplishing it? I mean, how can you do it so other people can do the same thing?
Hopefully very nearly accomplished. So yeah, firstly on the current wine investment market, it's unregulated, but there's absolutely nothing illegal or shady about it. It's just, you are just buying wine. You can't regulate a market where you're just buying wine or watches or whiskey, because there's nothing stopping you from buying it at any price or selling it at any price. You don't need investor protection. But firstly, that's not sufficient for the upper end of the investment market. Certainly is not investment. It's not institutional grade. And, we wanted to very comfortably and competently stand up on stage at Financial Times Digital Asset Summit, as I did last week, and say, this is legally an investment product. We have our token issuance in X jurisdiction. I don't think I can actually currently say where it is for the next few weeks. Sam might tell me off. And we are compliant in Y and Z jurisdictions for promotion, offer, distribution. No one else can currently say that, which gives us immense credibility. So this comes back to when I started Savea over 3 years ago. Within the first couple of weeks, we had to make a call. Were we going to go the way of most crypto projects or digital asset projects, because there is a distinction, and skirt around regulation for as long as possible? There was certainly something attractive about that. I've always come from a kind of non-stop, relentless sales background. You've got a monthly target, hit it, reset. So I like to move fast, and something doesn't need to be perfect. It just needs to be, go, iterate, get better. But we, partly because of my co-founder's background, Lee, he's had several companies in the tech, particularly fintech company. He was very pro the idea of regulation. And what really sold it for me was regulation's coming, right? For the crypto ecosystem to become mainstream, for adoption to go beyond the degens and the crypto natives, it needs to become more user-friendly, and there needs to be better framework for protection, because more traditional people and investors do expect a little bit more level of protection and legal clarity, even if it's not like full. So we thought, okay, if we not only seek to get regulated, but to be part of the conversation and shaping it, that's a huge advantage, because we get to shape it around us. Like, our product is the use case that it's structured around, and everyone else has to fall in line with us, not vice versa. So the first 2 years of Savea was spent on kind of product and tech, fully stealth mode. I went off the radar completely. The last year, in fact, the last 18 months has been purely working on regulation. We could have launched 1.5 years ago, but we wanted to get regulated. So initially, we were in talks in Singapore. I was living in Singapore for 6 years. That's where one of my networks is very strong. We were talking with the MAS, the Monetary Authority of Singapore, who are outwardly very dynamic, very pro-crypto, very pro-innovation and fintech. A lot like Dubai, they're doing a lot of work to pull talent and interest and innovators in, which is really cool. It's an amazing business environment, Singapore. Really, really impressive. But MAS, it kind of got 95% of where we needed it to be. But it wouldn't allow the final 5% of what was absolutely necessary for our token design. And again, I can't say what that is yet, but for us, that was a deal breaker. And we knew that we had time. We knew that getting the right regulation was paramount. So we shopped around for the right jurisdiction. We spoke to BVI, to Cayman Islands, to Malta, to Dubai. Dubai, we similarly progressed quite far. We worked with a law firm. We were speaking, got right, to the end of our application with VARA, and exactly the same comments came up. Interestingly, both with Dubai and Singapore, outwardly come and do business. Like we'll regulate you, come here. They actually both deferred to the UK. Both of them said, what does the FCA say? If you get approved, in fact, they said, if you get approval in any other jurisdiction, come back to us and we'll rubber stamp it. We just don't want to be the first ones to take that chance, which is interesting that they kind of deferred that way. So anyway, fast forward, and we found our solution. I'm just really trying to think whether I can say what it is. Yeah, I think I can, but not in much detail. Anyway, so we've got our we're working on our token issuance in Jersey, have been since last August, which is again really progressive. It's got a very pro status on tokenization. Had an established tokenization kind of track. And yeah, so we'll hopefully have our consent to issue in Jersey under the JFSC, and we can then promote, offer, and distribute with compliance in the UK and EU. Now, I hasten to add, that does not mean we're regulated by the FCA in the UK or by MiCA in EU, but we are compliant to offer it.
I'm trying to think of holes that I could poke in what you're creating here, and
how do we stop the criminality?
Yeah, no, I mean, I remember
scale.
I was an ICO advisor on ICO bench, and I mean, that was crazy times because the projects, most of the projects looked down upon the ICO advisors. I remember getting a contract where somebody was like, "You're going to be you as an advisor are going to be responsible for all of our expenses," and I'm like, "No, I'm not. I ain't signing that." But it was scammy. What you're talking about doesn't seem, and it's not scammy, but you said you're going to put everything on the metaverse, and just do these communities around the world, all of them have access to the metaverse. Are they going to have the opportunity to be these, which called piranhas or minnows or whatever, minnows? And if they're living in countries and where they don't have access to the metaverse. So
if you are a Hindu in North Korea, you're SOL. You don't get to be on it. So our goal, our fat, hairy goal, as people say, is to get 1/10 of 1%. If that, we have 4 times the audience of the American Shark Tank. We have 10 million people. If we have 1% of the tribe, we're just blowing it out the doors. We have 100 million people. We are the biggest thing on earth at 1%.
So I don't really, so there's not really a hole then. So I'm just trying to see.
Well, you missed the one thing, the criminality. How do we mechanically stop it?
Right.
The scale. So it's the go to market, the GTM, go to market. Most coins drizzle a little bit at 1 penny, as an example, to the insiders that pay their expenses. They then go to the public at $1, and then they artificially pump it from $1 to $20. They dump it at $15, $16, $19, $20, get rid of their stash, and then it just collapses on its own weight down back below a penny. This is how the typical pump and dump works. Okay, how do you prevent this? How do you structurally do this to where you can do a Satoshi Nakamoto, set it and forget it? We invented the scale. We have 100 million coins. That's all there'll ever be, 100 million. And we don't clock it out every 10 minutes. Someone can come in and buy it all the first day. Good luck. But here's how it works. We sell a bunch of coins at $1, then $2, $3, $4, $5, all the way up to $1,000. This prevents the pump. If you look deeply into our asymmetric scale, it would cost around $30 million to move it from $15 to $25. So it's almost impossible to pump it. But even if you did, you're now at $25 and you're dumping everything. Okay, fine. It can only go down to no less than half. It can only go down to about $13 because of the gold. The trust will buy the coins in the open market and sell the gold, because at every single level up, you're buying what is known as the scale equivalent of 100% of gold. Now, when the equities come in, and the Shark Tank is having their weekly shows and getting equity every single week, if it just starts resting at the $25 area, the base bottom strip and go naked buying will go from 13 and slowly rise to 14, 17, $20 and have upward pressure because of the increasing value of the equities.
Got it. So you really have a range that the range of high and low. So you're controlling. So it is. I get it. Basically.
Yes, it's somewhat controlled, not exactly controlled. Yeah, and anyone can buy it at 27, 127, 927, and at $1,000, there's no more coins left, and it just free floats.
It sounds good.
And by then, you'll have at least $500 of gold backing each coin.